Hello everyone. In this video we're going to talk about the security market line and its application in assessing an investment performance. To determine the performance of an asset, we have to consider the asset's risk, since riskier assets should on average have higher returns to compensate their risk. The security market line, known as SML, is a standard method of measuring investment performance. To compare two investment opportunities in order to choose one over another, in CAPM concept, we should indicate whether a security has risk-adjusted underperformance or overperformance, which we're looking for overperformance, obviously. The SML shows the relation between an asset's risk and its expected return. An asset's risk is measured by its beta, which shows how sensitive the asset's return is to changes in the market return. The higher the asset's beta, the higher the return investors expect from the asset. Here is the SML formula, in which the expected rate of return for any asset is equal to risk-free rate of return plus beta multiplied by expected rate of market minus risk-free rate of return. And how do we compute beta? We need the covariance between returns of that asset and the market return divided by variance of the market return, which we show it with sigma. Now we are going to talk about the regression statistics. SML is a risk-return relation for all risky assets like stocks, bonds, or you can even use portfolios in SML. Beta measures the sensitivity of a stock's excess returns to the index's excess returns and is the most common measure of a security's market-related risk. For example, a beta of 1.5 shows that on average a 1% increase in the market's excess return was accompanied by a 1.5% increase in the excess return on stock. This stock is an aggressive one because when the market goes up, stock's return tends to go up by more and vice versa. An asset whose beta is less than 1 is termed a defensive asset. Alpha is a measure of the extra performance of a stock. Suppose the stock's alpha is 2%. Alpha tells you if the stock's returns behave as predicted by regression equation, investor will earn 2% more than the market risk-adjusted return. It means that this stock has a positive net return in excess of its risk. This is why alpha measures the risk-adjusted overperformance or underperformance of a stock, in which we seek for positive alpha. Now we're going to talk about the diversification and its impact on regression statistics. Now we regress the excess returns of a portfolio of stocks on the excess returns of the index to measure risk-adjusted overperformance or underperformance. At the end of this PowerPoint, we're going to look into an Excel file and see what's going on in real for regression statistics for diversified portfolio. The point is, portfolio diversification results in higher R-squared compared to every asset composing it individually. The portfolio alpha and beta are the weighted average alpha and beta of the individual stock alphas and betas. This is easy, so we can compute it easily. But the portfolio R-squared is larger than the average R-squared. The truth is, the R-squared of a well-diversified portfolio is higher than the weighted average R-squared of the portfolio assets individually. It means diversification pays by reducing the non-market risk associated with the portfolio. Now here we need to talk about the types of risk. Market risk is also called non-diversifiable or systematic risk. This risk is measured by beta, the sensitivity of an asset's returns to the returns of the market portfolio. Since when the market goes up, the general tendency of most stock returns is also to rise and vice versa, market risk is inevitable. But the return riskiness that is not attributable to the market return is diversifiable or non-systematic risk. If a stock's R-squared is low, it means that the non-market components of return riskiness are much higher. The increase in R-squared resulting from portfolio creation means that much more of the portfolio's return is predicted by the market, and this is good. You lower the risk by making a portfolio. For a well-diversified portfolio, usually 20 to 30 stocks suffice to give a high R-squared. When R-squared is above 70%, most of portfolio's risk is market risk. Remember that on average alpha must be 0 and the average beta of all stocks is 1, like the beta of the index. So consider a portfolio, which this portfolio is actually a little market. You have made a little market portfolio in your own portfolio. So the average beta of your portfolio should be equal to the beta of the market portfolio, which is 1, and the average alpha must be 0. And you're not going to get positive alpha by investing in the market portfolio. If you're willing to invest in funds, it is important to remind that some funds charge investors for managing. So in order to compute a fund's alpha, you should consider its managing fee and subtract it from alpha. In this way, you actualize your return and your expected return from investing in a fund. The efficient markets hypothesis tells us that it's very difficult to make money using only publicly available information. Thus, there is no reason to believe that investment managers can provide better investment performance than you would get in an otherwise well-diversified portfolio put together by yourself. In fact, there are 2 reasons for believing that investment managers may provide even worse results. They charge fees, but we should consider brokerage fees and opportunity cost of the time we spent gathering information if we're going to do this by ourselves. Many investment managers like to turn over their portfolios, which in turn incurs costs for the investors and lowers their returns. For these 2 reasons, many knowledgeable academics prefer investing in index funds. The aim of these funds is to closely replicate the composition of a market index like S&P 500. These funds provide a highly diversified portfolio with low cost and with minimal interference in the investment decision by a portfolio manager. The average alpha of mutual funds is negative, and there is little evidence that mutual funds are able to provide superior investment performance. Now we're going to open a spreadsheet and you will see all these examples in real. And this spreadsheet contains the data necessary to measure the performance of random companies. Annual return data for the S&P 500 index and 3 random stock for the 10-year period are included. The returns include dividends. So if you want to know how do we calculate the return of a stock or an asset in a specific period of time, you should get the stock price at the end of the period minus the stock price at the beginning of the time period plus the dividend that you have gathered from the company divided by the stock price at the beginning of the time period. We are considering annual data, so the risk-free rate is taken to be the return on a 1-year treasury bill, and this is a very important tip to remember. The excess return is the difference between the return on any security and the risk-free rate for the same period. We can even compute the excess return of the market portfolio. We want to know whether a stock has risk-adjusted overperformance. So we regress stocks' excess returns on the excess returns of the index. To perform this, we estimate the best line that passes through the points on the graph. We try to explain the excess returns of stock as a linear function of the excess returns of the index. Here you can see the regression line formula. The return of a stock is equal to alpha, which is the intercept, plus beta, which is the slope, calculated in the spreadsheet, and we're going to give a look at it. And then we've got the return of index in a specified time period minus risk-free rate of return in that same time period. Now in this spreadsheet, we have annual return data for S&P 500 and 3 random stocks. We call them A, B, and C. And we've got the risk-free rate of return, which is equal to 1-year Treasury bill rate of return. The regression of the stock excess returns on S&P 500 is done here. We've calculated alpha, beta, and R squared. And the formula which we used is intercept, a function of Excel. As you can see, we have calculated the intercept between the stock return minus the risk-free rate of return, which is equal to excess return of that stock A. And we have got the index return minus the risk-free rate of return, which is equal to excess return of the index. And then we've got the beta, which we calculated by slope function in Excel. And we do give same parameters I used for alpha. And then we compute the R squared with RSQ function of the Excel. And we do give the excess return of each stock for calculating R squared for each of them. And now we are going to compute portfolio returns and portfolio alpha, beta, and R squared. And we are going to compare the results with the first example. First of all, we should assign portfolio weights to each and every stock we have got in the portfolio, which is as follows: 25% for stock A, 35% for stock B, 40% for stock C. And then we have calculated the index excess return and portfolio excess return to make it easier to compute the statistics. How we've done it, the index excess return is easy. You just subtract the risk-free rate of return from the index rate of return. And for portfolio excess return, you just have to multiply each stock's weight to the rate of return and then subtract it from risk-free rate of return. And in this case, we have computed a portfolio excess return for all these 10 years of data we've gathered. Now we've got alpha, beta, and R squared. And these alpha, beta, and R squared are computed as the same way we did it the first time, with intercept function, slope function, and RSQ function. As you can see, the R squared of each stock was 0.3, 0.2, and 0.2, but the R squared of the portfolio is 0.4, which is really good. You have eliminated some part of the risk by making a portfolio out of these 3 stocks. And now we're going to compare these numbers with the weighted average of individual parameters that we had earlier. So if you want to know, we've got 25% multiplied by stock A alpha, and then we do it for the beta, and you can see that the result is they're equal. We've got around 0 alpha, and the beta is the same. Both is 0.7. But the average R squared is 0.2, while it is not actually. And this is the difference between making a portfolio out of 3 stocks instead of investing in each of them individually. I hope that it's been useful for you. If you have any questions, write them in the comments.